A few days into the new year, Nvidia's share price has climbed significantly. This follows a remarkable 171% increase in 2024. By January 6th, the stock had risen nearly 9%, outperforming the broader market by almost 8 percentage points so far this year. This strong momentum has many investors wondering how long these gains can continue. Although it's difficult to forecast near-term moves for this graphics processing unit specialist, it may still be worthwhile to evaluate whether Nvidia remains attractive at its current price. After all, short-term fluctuations matter less for those focused on long-term investing. So the question is, does Nvidia represent a good value right now, or is its current valuation already reflecting future business growth? Before we begin, this video is not an investment advice and must do your own diligence. However, with my experience investing for years, the content from this video has a solid research foundation. Check our Patreon on the description below for an inside members-only access on what are the best buys now. We will also update you on what to sell for gains or to avoid losses. Subscribe to our channel so you will never miss out. Nvidia's business is currently experiencing remarkable momentum, with revenue soaring by 94% year-over-year and 17% compared to the previous quarter, reaching $35.1 billion. A significant portion of this surge, 88% of the total, comes from data center revenue, which has grown by 112% over the same period last year. The data center segment continues to benefit from the robust demand for computational resources needed to power artificial intelligence solutions. According to founder and CEO Jensen Huang, the age of AI is in full steam, propelling a worldwide shift to Nvidia computing. This rapid adoption of AI technologies spans countless organizations seeking to enhance workflows, as well as countries recognizing the critical need to invest in domestic AI infrastructure. This heightened demand also drives impressive profitability. Nvidia's net income now stands at $19.3 billion, more than double the figure reported a year ago. In addition, the company's balance sheet has become exceptionally strong, with approximately $38.5 billion in cash, cash equivalents, and marketable securities. Nvidia continues to allocate considerable resources toward share repurchases, spending $26 billion in the 9-month period leading up to October 27, 2024. Nvidia's soaring share price has lifted its market capitalization to almost $3.7 trillion. However, while the company's earnings and cash balance are strong, they still look small compared to that massive valuation. Keep in mind that Nvidia currently trades at 59 times its trailing 12-month earnings, a multiple that assumes robust growth will keep going well beyond the next year. It's almost certain Nvidia will maintain an impressive growth rate in 2025. Powerful tailwinds are fueling its business, and there's no reason to expect them to disappear soon. That said, investors should remember that the semiconductor sector goes through cycles, and it's an extremely competitive field. Take Intel as an example. There was once a time when it seemed unbeatable, yet its shares have declined sharply over the last 5 years due to fierce competition and rapid technological changes. Could Nvidia face a similar setback one day? While that scenario seems unlikely in the short term, there's a subtler risk for investors. If Nvidia's growth moderates or its profit margins shrink, people might begin to doubt the stock's high valuation, potentially leading to a steep decline. Even a small hint that enterprise AI spending may be nearing a peak could be enough to rattle the stock price. With all this in mind, it may be wise for some to stay on the sidelines for now. Nvidia is an outstanding company, but its lofty valuation may already reflect much of its anticipated future growth. Give us a like if you like our video, subscribe, and ring the bell to never miss out. Check our Patreon for an inside look on what are the best buy and sell stocks every week.